Welcome to ACY Securities. I'm Ira Reyes, Macroeconomic Strategies. Oil is surging toward $90. US and Iranian forces are trading airstrikes for a 10th straight night, and global markets are on high alert. Here is what moving the markets right now. Just a reminder, this represents my personal view of market movements and does not constitute investment advice. Trading involves a high degree of risk. Please ensure you have a solid risk management strategy in place. My strategic analysis is I utilize the dual layered approach that synthesizes macro level catalysts with technical precision. By cross referencing fundamental shifts against statistical trends, I execute high conviction trades where market sentiment meets optimized expectancy. Dampen overall energy consumption and forcing right now the market to temper its growth projection. So forcing as well the cartel. So here for the conditional output adjustments, we have the leading OPEC Plus members. They are opting for cautious, small-scale tweaks to their production schedules, such as incremental shifts of 188,000 barrels per day instead of the sweeping policy changes. We expect as well why on this one. Why? Because the group must maintain their stable supply levels while there's a navigating past overproduction penalties alongside the volatile risk of ongoing military strikes in the region. Next, we have from the market of here for China's Giga AI. So the Chinese world model startup, the Giga AI, is discussing right now a Hong Kong initial IPO or initial public offering as soon as this year following a new funding round that values the Beijing-based company at $3 billion. So if successful, the firm would become the first world model startup globally to go public. Next, we move to the stocks. So just to highlight what happened yesterday, US and European stock indices closed mostly lower yesterday as escalating conflict between the US and Iran disrupted oil and LNG tanker flows and also fueling energy-driven inflation and rate high concerns. Traditional sectors, major banks, and manufacturers declined sharply under this macroeconomic pressure. And we see as well the chip makers and the select tech stocks, we saw a rebound. And meanwhile, the European markets remained yesterday muted due to rising global yields and surging fuel costs weighed on discretionary spending and corporate earnings. We have also today the Asian equity markets. We can see it advanced right now due to a pullback in oil prices and easing sell-offs among semiconductor stocks and supported as well the regional sentiment. With chip makers in Japan and the South Korea, it also led the gains. Plus, we also have the Chinese equities. It outperformed following there is a targeted government support measures designed to stabilize the technology sector during ongoing geopolitical developments. And as of today, we can see as well the EMEA or the European equity markets. They were poised for a slightly lower open as investors as well monitored these ongoing US-Iran hostilities while awaiting as well for the potential ceasefire developments. And the markets as well, their participants, they are also looking ahead to the upcoming European economic data and anticipated interest rate hold from the ECB and a light corporate earnings calendar. So again, these are what happening on the equities for today and yesterday. And again, besides from the equity, the earnings report, one of the prime catalysts for this week would be the headline from the Middle East. And you can see the surge in oil prices almost nearing the $90 level. And today, as of today, the gold as well, it moved past the $4,000 threshold. Next, we have the stock futures. So stock futures held steady yesterday. And again, markets, they brace for higher oil prices driven by this conflict. And also there is a new tariffs on Canada. So major US index as well, they dip earlier in the day due to energy costs and a drop in Apple shares. So traders as well shifting their focus right now towards the upcoming corporate earnings and AI spending updates from tech giants like the Alphabet and Tesla. We have the commodities. So you can see right now the energy and the precious metals right now. So just to give you as well on what is ongoing for the gold, let's prioritize the gold. So yesterday the gold price remained steady around 4,000 level, so or an ounce, as markets watch the conflict and also including the rising energy costs. So they're waiting for clues about the future inflation. So having this one as well for the market, we can see for the gold. So again, markets are also waiting the possibility of the Fed raising interest rates. So again, most traders are expected to wait for the Fed's upcoming rate decision next week before making major moves. Now, we also have from the Houthis. So again, another is this is one of the not actually the catalyst, but rather one of the things that we have to monitor as well on the ongoing war in the Middle East. So how Houthis Red Sea threat risk bigger oil shock? You can check as well the movements of the current oil prices. So Saudi Arabia has been using its Red Sea port of Yanbu as a crucial alternative route to bypass the Strait of Hormuz for oil exports. However, because of the renewed attacks, and there's a blockade as well threat by the Houthi militants in the Bab al-Mandeb Strait, it threatens as well to cut off this vital workaround. So if these maritime attacks prevent tankers from using the route, global oil supplies could suffer a major shock and also prices could surge even higher. Now, financial markets, higher crude oil prices as well, and soaring shipping expenses, it would really cause immediate volatility and surge across global financial markets that, again, we can see ongoing within this week. How the markets intensify its movement in relevance to what is ongoing in the Middle East. Again, for the economic indicators, the impact of this one would be there will be severe energy crisis that would really intensify inflationary pressures and drastically as well slow down worldwide economic growth. So again, we can see again a group of economists would have a forecast relevant to in relation or pertinent to this ongoing escalation in the Middle East. So that's what we have to watch out. Now, what are expectations aside from that? So again, energy markets and supply shocks cutting off Saudi Arabia's Yanbu export terminal via a Houthi blockade, it would really severely constrict oil supplies and force the crude prices to spike dramatically. And at the same time, so supply chains and trade rerouting, so cargo ships around the tip of Africa would drastically as well. It would lengthen its deliveries or schedules while inflating freight and insurance expenses. For the inflation and monetary policy, we can see that there is a persistent shipping and energy battle next year, and it would also revive the worldwide inflation. So that would be the result if this will not be resolved again. So that this would also prompt the central banks to maintain the higher interest rates for a longer period as well for the next half of the year. And also economic growth and stagflation risk. So soaring energy bills, again, expected, and also expect some restricted industrial output together with raise the threat of global economic stagnation and downturns. And for what happened with the risk in the Middle East, so crude oil and Brent hovered near 5-week highs, above 82 and 89 per barrel. So as the ongoing conflict here, it would severely disrupted vessel traffic through the Strait of Hormuz and the Red Sea. So although a potential 10-day ceasefire and mediation proposals emerged to ease the tensions, there's still a tightened global supply and ongoing military strikes continue to support elevated prices. So again, later I will also discuss between the oil price and the gold. Next, we have the UK. So the Britain's labor market, it showed signs of stabilization for the month of June, as payrolls as well, it dropped or fell better than expected of 4,000. This is the figure right now. And unemployment rate at 4.9% as well. So this data, again, it arrives ahead of the BOE interest rate decision, or the Bank of England. And officials as well, they closely monitor the wage growth, which remains steady at 3.4% to gauge inflation risk. Meanwhile, the new Prime Minister Andy Burnham has inherited a sluggish economic backdrop and pledging economic reforms to scrap the VAT on energy bills. So that's the latest from United Kingdom. So if you're tracking the sterling, again, they're tracking as well the VAT on the energy bills. And for the currencies, just to have a summary, so the Australian dollar reached a 4-week high near 0.70 due to energy inflation risk and rate hike. While the US dollar as well, it went to 101. So let's take a look at the DXY. It went to, after the high went as high at 101.9 during these escalating Middle East tensions. Now, the sterling, it near the 1.34 following of unexpected cabinet appointments by UK Prime Minister. And at the same time, there is a sticky inflation and slowing wage growth. And meanwhile, we see the euro, it remains steady above 1.14 level due to the markets are anticipating this cautious ECB policy meeting following its June rate hike. And at the same time, across the global markets, the ongoing Middle East and regional energy inflation as well, the concerns on these two, it would really continue to heavily influence central bank expectations and currency movements. So again, to have a summarize on that, we are leading towards market uncertainty again. And again, markets does not like uncertainty. So we are very cautious with our projections, not only on the equities, but rather on other indicators as well. We have the oil prices as well. So take a look. So here, oil prices, it edged up due to the issue in the Middle East and including attacks on the shipping routes and energy assets. So it sparked fears of a global supply crunch here. And again, we can see the West Texas Intermediate, it settled as well near the 83 barrel, while the Brent temporarily topped to near the 90 level. So this is driven by low global stockpiles and aggressive trading as well. Meanwhile, mediators are attempting to negotiate a temporary ceasefire between the US and Iran just to revive or help these peace efforts and stabilize this volatility in the energy market. So again, how we view the implication of this one, inflation pressures. We can see higher oil and fuel prices as well that would also increase the of making moving goods. And also at the same time, on the consumer prices, it would also reduce the purchasing power in terms of how these ongoing in the Middle East tension would also intensify. At the same time, for the monetary policy, so again, at the same time, central banks, they may need to keep their interest rate high. And again, the volatility, so there is a geopolitical supply fears that would weigh down on the stock price and also drive government bond yields higher as investors reassess this risk. So let's take a look on the gold as an example. So you can see the movement of gold from 4,000 level going right now. The doing price is 4,062.24, 4,062.24. Now, based on my plot on the prices on lower time frames from 1 hour chart, 2-hour chart and the 4-hour chart plus the daily chart. So there's a retest or break zone for this one. So 40.64 is the retest to break this level. So, and at the same time, the support levels 40.29 and 40.10, and there's a major swing support at 39.78. So there is as well a short-term bearish bias for the XAU USD. Now we can see as well earlier, this is a neutral to bullish momentum reading at 46 level for the RSI. We also have the moving average convergence divergence, sorry. It shows as well there's a fading negative momentum. We can see as well the histogram bars. It was shrinking and moving closer to the baseline crossover point. Now, RSI having that level, it ticking upward from the lower of the half as well. And right now it's dropping. Now, it also indicates as well that there is a pressure as well with easing on the selling pressure is easing and buyers are regaining control. That's how we look on the RSI market. So this is based from the 2-hour chart. Let's take a look on the daily time frame. So that's how we view the market right now. Exactly that. The indicator reinforces the shape of the red histogram. So there is a flattening out and shrinking toward the zero line as well. So it signals as well that the previous bearish momentum is losing steam and a potential bullish crossover could be on the horizon as well. So we watch on this level of 40.64. Let's move again to lower time frame. 40.64, the retest level to break. So a confirmed breakout above this price region, it would also give an open or a space for long positions targeting this 40.85 level. So that's what we are looking right now. Again, it's 40.63, but once it has been stabilized to until the New York session or within the week, you can see it would go up to 40.85 until it goes again to this 41 level to 42. So again, the current trend for this one is short-term bearish to consolidating and remaining under downward pressure as well. When we look on the daily chart, that's on the bearish consolidating. So despite there is a recent attempts as well to defend its psychological price level. And again, we can see as this one as example as a high market volatility at the moment because we are not only because we are on the European session and at the same time waiting for the New York session, but rather the demand and supply, particularly or the inventories that right now we can see the market has been focusing right now. So again, that's how the market react in terms of the headlines. Very immediate, the spikes, plus we look on a lower time frame. Now for the goal, at the same time, the current trend for this one is short-term bearish, but the gold again it continues to just above the 4,000 price level, and currently it also changed near to 47 level on the 4-hour time frame, and it stays as well trapped inside a downward channel that there is a subsequent as well to pull back from previous peaks. So again once this has been broken and once it reached to this 40.85, because this is a lower time frame, expect that this would stabilize to 41,000 level or 41 flat. And again, this is a bullish term for the gold. So this is very cautious this week because we are also anticipating the movement of the XY through the support of the corporate earnings like the tech giants, again, the major companies. Plus, at the same time, we have the jobless claims, the weekly jobless claims for this week. So again, rate hike or higher for longer expectations that really have sustained this persistent inflation data, and at the same time the Fed hawkish guidance, it has really strengthened the US dollar and put pressure on the non-yielding assets like the gold. And there's also, while rising tensions in the Middle East, such as there is a worry in the Strait of Hormuz right now near in Saudi Arabia, so it typically would really surge demand for safe havens. They have also increased the cost of energy oil, again, this is commodities, and raising concerns about inflation and supporting the Fed cautious approach. So you can see last time why the gold remained steady like yesterday, because there was an ongoing or intensified um, crisis in the Middle East. So gold has not really reacted the way that people usually expect during the Middle East conflict. And so instead of shooting up like a classic safe haven asset, so it's mostly stayed flat, and occasionally it also dipped like what is ongoing earlier, and right now it surged. So why there is a quiet momentum that is currently happening. Again, this is for the gold. Energy and inflation. So the fighting that has hit the oil supplies and the shipping routes hard. So at the same time, making as well the crude oil prices jump. So there is a keeping of an inflation that would worry, that would remain. So there is a inflation or the worry. So it would also force right now the central bank, like the Fed, to keep the rates high instead of cutting them. Again, you can see the chain reaction of the energy and inflation. So when you see the crude, it jumps up or shoot up. Again, there is an inflation worry. Right now, what would be the reaction? The central bank, like the Fed or the ECB and so on, they would keep their interest rates high instead of slashing them. Again, we are removing the classical scenario of how we anticipate the ECB or the central bank's policy meetings. Next, the cost of holding gold. Of course, the gold does not pay that interest. So when inflation fears, it push the bond yields and the dollar up, because again, the yields are one of the catalysts as well, or a signal for the gold. So again, when inflation fears as well, it push the bond yields and the DXY to go up. So cash and the bonds as well, the bonds, it would like much better options. So basically, the market is more worried about high rates now, right now, than it is about the ongoing conflict. And there will be a competition as well from the US dollar when things get tense globally. Again, big investors they often run straight to the DXY or the US dollar for safety, which keeps right now a lead on how high gold can go. And we have to remember that gold is priced in US dollar. So that's how we see an insight or why it remained as well steady. Now, what does this mean for the gold trend? So even though the gold has been bouncing around near the 4,000 level, and after coming down from its record highs, its bigger picture is still solid, because short term versus the long term. Again, before a month ago, I mentioned as well about the World Gold Council, how it would impact as well the demand for the gold, not for the short term or medium term, but rather on the long term. So right now, it's stuck between the high interest rate bets and at the same time on the energy shocks. So, but down the road right now, it's still supported by the central banks. So, having to purchase or having those reserves. And there is a massive global debt as well, and shifting to trade patterns. And there is also a new way to trade it, as investors are not just panic buying on the same time based on daily headlines, but they are using it as a solid long-term shield against this creeping inflation and at the same time a weakening currencies. So that's how we view in terms of the gold, because gold is not the same as the oil. When there is a if there is a spike in oil prices, people the markets may refrain from it. It's because it's a daily necessity, but rather it's really affect their pocket or wallet depleting at the same time. So gold is an investment at the same time. So it's just how the investors or markets will shift their assets, like non-yielding assets like the gold. So overall, this commodity is not just losing its value or purpose, but it's also just taking a breath or room and consolidating as well while the broader economy sorts itself out. So that's how we look on the movement of the gold, why it did not react that much as the markets as well anticipated. Now, to have that latest earlier, few hours ago, so the gold climb here. So again, we can see it would also break the retest of 40.64. So it was 40.50 an ounce, rebounding from recent losses as investors as well. They weighed on the potential peace agreement or negotiations as well that could also ease inflation risk. And meanwhile, elevated geopolitical tensions and there is a rising treasury yields as well, with markets are already pricing in a higher chance of the September Federal Reserve hike that continued as well to influence the market sentiment. So gold is floating here near the, still we have to remain at this 40,000 level because it's just 46.59 and it may retrace back as well. So it's caught between the Middle East tensions and interest rate expectations. And there is a diplomatic hopes as well that have sparked a bounce toward the 450, and but energy shocks as well and the rate hike, it really keeps a stronger dollar in play and at the same time risking a drop toward 39.78 support level. So that's for the gold. Let's move forward to West Texas Intermediate. So this is the 4-hour chart. So the market is currently showing an upward and sensitive bullish heading into this week. And there is a price range of 82 to 83 per barrel. And you can see already what are the key factors for this one. So we see, again, the tension in the Middle East. So as it intensifies, and of course, because of the supply disruption, and at the same time, the technical levels here that we see, I have the highest resistance that I could provide for within the week based on the lower time frame, plus the movement of the WTI based from how sensitive it is to the headlines. And also we are tracking the weekly crude oil inventories as well. So 86.724, the highest resistance based from the daily chart as well, plus the next would be the 84.368. 83 flat is the immediate resistance right now, and there is a retest of 81.494, and at the same time here the lowest support would be on the 78 level. So 80 going to 78, these are the support levels or the zones that we are tracking as well. Now supply and demand fundamentals as well. During strong seasonal summer, it would also fuel demand combined with tight domestic inventories continues to provide support to energy prices. So that's what we have to look as well. Inventories not including the Middle East tension. So having this as I've established the 86.724 immediate resistance as well at 83 flat. So moving average as well in the Bollinger Bands, we see that this 200 EMA, it's running across the upper middle section of the chart as well. So it acts right now as a macro trend filter. So the Bollinger Bands here, we are currently framing that volatility and showing that here at the middle band as well, and outer boundaries guiding recent price swings. And RSI as well here, we can see it's currently printing at the 67 level. So there is tracking of upper neutral territory and approaching but not yet in overbought conditions. Plus, we have the moving average convergence divergence or the MACD panel. So the signals are also flattening out with the histogram bars as well, showing moderating momentum after the recent bullish push. So that's for the WTI. So the main catalyst again for this one, the inventories that we need to track. So if there's a positive supply, we can expect as well not much spike from the WTI, but rather what we have to incur or to factor in our variable when projecting the price movement of WTI would be the headline from the Middle East and anything relevant to the OPEC. So would they be able to sustain the next half of 2026 for the global supply demand, having these tensions in the routes of Strait of Hormuz plus along Saudi Arabia? So again, that's how we look for the WTI. We can see as well it's surging. The surge is continuing from time to time whenever there is a high attack in the Middle East. So again, I guess that's it for today. Any questions relevant to today's market analysis? So by the way, you can check our website. So here's our website. Head over to acy.com and go to the latest news section. And you can see as well our market analysis and education. So we provide update this from time to time. From price action, we have Mr. Rafi Grant Capascio. So he also has report or analysis relevant to the gold. You can check it on our website. We also provide education as well. So now if you want to join in, just have this our scan our code and register as well for our dashboard and start tracking the markets. And you can join our Discord. The link is in the description box below. And you can check as well our trading cup. So here's our trading cup. So you can mirror their strategies or copy their trading directly while keeping the technical analysis as well easier to understand. Again, markets are moving fast, so stick to the plan and secure our lead and make it happen. So again, thank you for joining, and I hope today's session provided you with some actionable insights relevant to the ongoing high intensifying conflict in the Middle East and how it really rattles the market globally. So again, have no fear. Ira is here all is well, and thank you for watching. See you on the next live session.